Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex. I'll start with Chicago soybeans. Finally, some movement. The market had previously sat within the congestion zone made up of the lesser Fibonacci levels of 1400, 1389 and 1378. These three have halted any falls in this market since late July and actually held up the market in August, September, the start of October and the last few weeks. In this process they had gathered ammunition for an attempted move higher, and we have seen that this week. Additionally, the larger process had been a possible descending triangle, with the upper trend line being the mid-August to date downtrend, currently at 1426, backed up by a little higher up by the paralleling and declining medium moving average, currently at 1442, whilst below those same levels at 1400, 1389, 1378 acted as the base of the triangle. Last week I pointed out the following, and I quote, "This triangle has a limited lifespan. It will be over by the end of November. In the meantime, the operation area between trend lines will be narrowing all the time, and the chances of a false break in either direction will be increasing. I cannot say yet which direction the break will take place, but I can give some idea of the size of the break, if this pattern works through. If the market makes a confirmed break above the downtrend line, then the primary target area for such a move would be $1.15 above the confirmed break level, and the secondary harder to achieve target area would be $1.75 above the confirmed break level. A confirmed break lower and a secondary target, a confirmed break lower would have a primary target zone 87 cents under the confirmed break level, and a secondary target zone $1.75 under the confirmed break level. Of course, this is just for this pattern, if it remains a descending triangle and doesn't turn into something else." End of quote. The market since then has broken up through the upper trend line as well as the declining medium moving average, plus the 50% Fibonacci line of December 2020 to February 2022 move at 1451, though this last one does not appear to be overly significant, well, at the moment. Yesterday saw the second consecutive close over the trend line and the medium moving average, and it would be appropriate to give some ideas topside for the descending triangle pattern. However, I am still mindful that this could be a false break, so just take care. Thus, a primary target X will be in the 1545 area, and a secondary much harder to reach target X1 would be in the 1605 area. So what have we topside that might get in the way? Well, to be honest, not much. We have highs in September at 1493 and 1508, but the next resistance topside is in the band between 1521 and 1534. That contains a flatlining long moving average, currently at 1534, and a 50% Fibonacci line for 2022 at 1532. It all depends on whether the current break higher is a true break or a false break. Chicago soybean meal. We have it here for a number of weeks and continues to have different patterns, not so much melding in with each other, but rather crashing in and out of each other. The main pattern has been the May to date seemingly broken, but then not quite broken, then not quite broken, ascending, expanding wedge pattern, something I pointed out many weeks ago. This has developed, currently 408.40 to 490.30, though it is not a perfect pattern. But the latest breach on the downside was seemingly mended last Friday, though since Monday's bearish action we are seeing the market cautiously approaching the lower trend line once again. Prices slipped the last 2 days below the ever so slightly rising medium moving average, currently 419.90, and down to testing the sideways moving short medium moving average, currently 415.90. Interestingly, the market's indecision has formed a sort of base since the start of October around the lower trend line. That is also the neckline of another pattern, and that's the huge December 2021 to the June 2022 head and shoulders pattern, continuation pattern, currently at 408.40. This second earlier pattern had been the signature pattern here since last year, and you can see how it resonates even now. It has the unusual though not unique feature of a head and shoulders top over February to April, crowning the head of the bigger head and shoulders pattern. Now going back to the neckline, This shallow uptrend had also been the base of a quad and arguably a quintuple bottom, so when a break below that, it became all very interesting. This highlighted the next key obstacle on the downside, which was, and still is I suppose, the 50% Fibonacci line, the October 21 to March 22 move at 40050. This still managed to wangle itself as a support. My earlier thoughts on tackling this specific support were not complementary to any attempt lower, and the action since has highlighted that. I quote, "Well, good luck with that. The market has tried that a total of 6 times so far since May with no result. I just keep an eye on the parameters of the ascending expanding wedge pattern, as that seems to be the key here." End of quote. We are as of today up to 9, possibly 10 individual attempts lower. Not just days, not just days, but groups of days bundled as attempts, and so far not making it. Over the last few commentaries, I had a suspicion that the moves lower might in the end be successful. I'm not yet convinced that this might not still be the case. So beyond the 50% Fibonacci line at 40050, we have another 50% Fibonacci line down at 386.80. This seems a reasonable area to look at next, lower down. I had previously placed some ideas on the downside. Thus, for an ascending expanding wedge pattern, the primary target X would be in the 367 zone, and a secondary harder achieved target X1 would be off the bottom of my chart at 340 in the 342 zone. These are big numbers to think about, and they are based on the move lower being a genuine one and not a false break, which, given that what we've seen in October, is still open to interpretation. Now, one final point that I highlighted last week, and I quote, "The action over October is now suggestive of a small sideways triangle, if you like a large pennant pattern, currently 398.80 to 408.30. This pattern has a half-life of the descending triangle idea, running out in the middle of November, so it would be interesting to see if this smaller pattern gives a clue to the larger pattern." End of quote. Well, since last week we had a break higher from this small triangle stroke pennant pattern. Thus, for a primary topside target, would have a target in the 426 area. This was achieved on Monday. A secondary hard to reach target would be in the 437 area. I've chosen for the moment not to mark the target on the daily chart given the bigger pattern and the spike we saw on Monday, but I will bear it in mind, just in case prices start turning back up from the neckline zone below. Chicago soybean oil. The key recent features here have been the weekly key reversal up 2 weeks ago, the bow tie formation last week between the rising short moving average currently at 68.56, the gently rising short medium moving average currently 66.67, and the flatlining medium moving average currently 65.65. This is not a perfect bow tie formation, as the medium moving average was sort of heading lower rather than higher, but it's worth considering, especially in light of the weekly key reversal up and the subsequent higher action, especially the market moving and stabilizing over the rising long moving average, currently 69.83. So, in a bow tie formation, not only does the market have a tendency to move in the same direction that the moving averages exit the bow tie, in this case mainly higher, but after 15 to 20 sessions after the crossover, that's between the 15th to the 22nd of November, we should see the start of a major move in the next direction of the market, again mainly higher as indicated by the majority of moving averages moving upwards. So I hope that is all clear. If otherwise, just please replay it. Other than those points, we have also seen the market during October move above the lower time, currently at 69.96 of December 21 to June 22 bullish Andrews pitchfork, under which the market had hung like so much washing since late September. The latest resistance that the market is challenging is a 50% Fibonacci line for 2022 at 71.97, as well as the 2008 previous all-time high at 72.67. This is after successfully breaking through the June 2021 high at 70.33, which had previously successfully capped the market back in late June, mid and late August, and again in mid-September. This area is now support. This zone is now support. Looking overhead, well, resistances start to become sparse. We have the middle time of December 21 to June 22 bullish shift pitchfork, currently at 75.61, and then congestion from May and June at 76.25 and between 77.73 and 78 even, plus the 79.5 area. I'd also drawn a possible recent bull channel, currently at 66.25 to 72.25. But this has been breached yesterday and it is of short duration, so I'm very cautious about using it. And there is one final point I highlighted last week which I'd like to discuss again today. It's something I've also pointed out in recent weeks. Here's my reasoning from last week, and I quote: I've had a suspicion that the action since June may be culminating in an extended V-bottom pattern. An extended V-bottom pattern is very much like a regular V-bottom, but the upward leg of the V has an extension such as a bull flag or some other form of congestion, much as we have seen here. Extensions may happen before the V as well, but for this particular market, we'll look at having post-V bottom. Thus, it would not be surprising to see for this pattern should it continue to see a move to the 74 even area. Given all that's already happened, these actions negate the monthly key reversal down we saw in September. And if they don't, then the move up to the 74 even most certainly would. End of quote. Well, as you can see, we've advanced from the 69-65 area, when I wrote that, up to just short of the 74 even area. So the extended V bottom pattern with what looks like a bullish halfway hesitation is a good one. Thank you for listening. This weekly broadcast gives you essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.